is the handout that looks like that. And this is actually one that hits close to home. This was my video about my brother-in-law. I know you're thinking that kind of brother-in-law, but no, it's he's actually a really fine and upstanding person. However, he got involved with some people that were not so upstanding, and this kind of comes about. One of the things that is always sort of fascinating to me is how, well, first of all, we find these frauds, especially ones that are large, there's usually many people involved. And there was the largest corporate fraud, well, Madoff was like a securities fraud. But the largest company fraud, I believe, in history was a Parmalat fraud. And it was about, I don't know, between $8 and $12 billion. But to me, the interesting part about it was that there were 76 auditors were charged with fraud. Not people inside the company, 76 auditors from the CPA firm were charged with fraud. And you know, how do you get, in a CPA firm, no less, how do you get 78 people to go in on a fraud? I mean, it's one of those things that is statistically impossible. You know, it's statistically impossible to get that many people involved in a fraud, because if you think about fraud, sort of like this. You know, one of the things that one of the key things that we do in fraud is say, okay, if you have, well, for instance, if you have people opening up checks in the, look how happy they are. If you have people opening up checks, say, in the mailroom and making a checklist, you say, okay, let's say that the person has a 10% possibility of being a bad apple. That's very high, but let's just say it is. If you put a second person in there, you know, now you're down to 1/100th. And it's probably even less than that, because even if you're inclined to do something wrong, you may not mention it to the other person. So it's probably even lower than that, even if they were, you know, this is a fairly high degree of, so anyway, you know, if you line that out to 76 people, it's mathematically impossible for 76 people to be so-called bad apples. It's just impossible. Oops, I just did something stupid here. So the question, well, how does it happen? Because it does happen. And this is a video, it was by my brother-in-law. And my brother-in-law did very well in business. He still is doing very well in business. But anyway, you know, he was involved with this company that and ended up having a lot of fraud involved in it. And it was very, it's very interesting in how do you get people to go along, you know, with the fraud, how that kind of all comes about. And it's very it's very strange, because a lot of times it's the best people a lot of times are the ones that end up doing it. So fraud is a very unusual crime. It's very unusual from any other crime too. If you actually look at the population of people who commit fraud, they're more, you know, if you take like a general prison population and you compare them to people who do the crime of fraud, it's completely different. People that do the crime of fraud are more like college students and their mentality than, you know, where you find the most criminal people, you know, that are in prison. It's a very strange thing, and it's also one of those things that the recidivism is very high. It's I don't know what it is, but it's very high. I think only sex offenders have a higher case of repeating the crime. It's a very odd group of people that are involved in fraud. And one of the things that makes them so difficult to find is that it is such an odd group that they will look like the perfect employee. That is that, you know, you say, well, who's committing the fraud? Well, look at your best employee. That, you know, that's where I'd start. The person that's always there, the person always wants to do, you know, always wants to do well in that. And those are the same people that either on their own or put into a group are going to be the ones that are more likely to commit it. So anyway, this video, so my brother-in-law, so he went down to the, yeah, I remember this. He went down to Texas and this big job thing, and they came back like a year later, and we were at some get together, and he said, you know, I really want to talk to you about this. Yeah, he said, and I said, well, I teach auditing class. He said, yeah, let me talk to your auditing class about this. And so I videotaped it. It's a very old video. The editing is very choppy. I think he talked for something like 3 hours or something. So it's cut down to, you know, whatever it is, 30 minutes or whatever. But anyway, he kind of follows along on this sheet a little bit. Let's see here. He kind of follows along on this. Kind of bump your way through this, and but it's actually very interesting in that, you know, here's this, you know, and he's the kind of guy that, you know, who coaches the little league teams, goes to church every whatever, and, you know, he was right in the middle of it. So this is so anyway, one of the odd things that happened is that my video, I thought, was in the correct format, but as I loaded it, I actually converted it to the format so that it could be in the Zoom format, but it's not letting me. So I'm going to play it on my desktop and share the desktop. So I think that is what I will do. Okay, so this is the video, and hopefully it's a little bit can you guys see that or no?
Yes, we can see it.
You see it? Okay.
Sure. Part of the story. I was answering an ad in the newspaper after I graduated from college, and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the U.S.
Can you hear it?
Started out as an assistant manager.
Yes.
Manager, a district supervisor. They were growing fast. They needed young, energetic people, and ended up in the purchasing department, which was a
We can't hear the video.
At the end of my 16 years there, it was over $1 billion of merchandise a year. I
Okay.
was one of many people
Thanks.
there. It was a very large organization, which has only grown since I left. But it was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen. And very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided that you knew you would leave there?
That's a very good question. One thing about Aldi is that they are so structured. There's a very clear corporate ladder that you climb. As an assistant manager in a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years, or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had. And one thing that I had never experienced, I mean, they were a publicly traded company. They offered me these things called stock options. And that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of company that Aldi was. And they were serious. They had the right package. And also something I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area. So I got to stay here. When I originally negotiated, it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also. So we set up an office in Northbrook. And I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all of the purchasing into their corporate office in Texas. And it was something that I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Lewisville, Texas. The whole company moved. They leased a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Lewisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hansen, and talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they were a large company. I said, how are you going to finance these new stores? He said, well, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there. We did get 17 stores open. And again, they were going on well enough that they thought my services were better used managing all the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler, is buying for? How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything was funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost, and that's where they got in trouble. this gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're going to let them be vice presidents of private label for all of Fleming, and they'll buy for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated, and these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th. This is the last time it's something on September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company. He couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information is 100% accurate. I have a lot of respect for the Wall Street Journal. It's a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, he finally reworked the language until it gets done and it gets put. It's a few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion, as I recall. We negotiated for it. Had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name in the old blue light specials. But they negotiated that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply Kmart, could supply Fleming, and could supply the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. Ice cream was a big deal. Ice cream is the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen case at your grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it, go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kim's Marigold had the plan. They had enough plants in different spots in the nation they could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated the deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They give Fleming Retail Group $1 million because now Kim's/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate for their private label group. So we had $3 million out there. Now what happened was in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share, or whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite and gets a handful of guys around him and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make up 30 cents a share, in a very short period of time and hit the projection that you've given Wall Street? If you don't hit it, that your stock's going to tank, and people will lose confidence in your company. Your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. My response was always, well, let's be more careful with the numbers we give everybody. nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company. And he sent very aggressive numbers to Wall Street. So we had a gap. And what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate 30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. It's cash, and the money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we've done best. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. He said, just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to me and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money, he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it? Shapiro, Mark Shapiro, is he on top there?
Yeah.
Yeah, Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, no, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Miracles about it. I said, oh, okay. I said, they know something I don't find. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold saying that this was some sort of rebate or something. And at the same time, their sales guy signed the agreement, the formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals I had done before, but now there was. And this is the way they did business. I mean, this was normal, and it still goes on today. Super Value is the major wholesaler that does business this way, and CNS Wholesale, there are others. I don't mean, I'm sure most of what they do is above board, but there is potential for danger. I signed that agreement, and we booked that money, and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number.
And your options also.
And options as well. I mean, because it's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job. And after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company had moved. And not only that, but when you move, Fleming was very generous with their relocation expenses. They had this executive relocation program. If you couldn't sell your house, this company would buy it for you and then sell it for whatever they could and take the loss. If you leave the company within a certain period of time, you had to reimburse them those relocation expenses, tens of thousands of dollars that I would have to pay out of my pocket if I left. the HR person said, you know, how are you perceived as a buying group out there in the world with Procter & Gamble and these other vendors that you deal with, and with some of your contemporaries, your, you know, other person groups? How is the Fleming group perceived? And my statement was that we were pirates. I mean, you know, we don't, you know, a lot of fun to hang around, but, you know, the guys around me would cut your throat at the end of the day. One of the guys next to me came up with this brilliant idea that, well, there's going to be shared savings now. Now that the vendors don't have to go to Troy, Michigan to call on Kmart and Louisville, Texas to call on us, they're going to save money. We're going to be easier to deal with. The volume's going to be greater. They're going to save money. So they sent out a letter that said, congratulations. You know, you're now selling to and working with this new larger company, larger purchasing organization. It's only going to cost you 3% of your total sales for the year. That's millions and millions of dollars, and hope for the best. We put enormous pressure on them. You know, we did over $1 billion in business with Kraft alone. One of the companies obviously that got fined is Kraft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming is a very important customer to Kraft, $1 billion in sales. And, you know, if it meant signing a letter that, you know, $7 million or $10 million would get funneled to Fleming somehow over a couple of years, we signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted it, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had, you know, worked hard for over 16 years with Aldi and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk, and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid, that those deductions were going to be repaid. My word didn't mean anything to them anymore, and I wouldn't. I would just tell them, I said, look, you know, we're all in trouble. You know, this is not going to work. You know, if you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. You know, whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that, as you know, elevates the cost, makes Fleming uncompetitive in the marketplace. And at the end of the day, that $450 million in cash flow that Mark Hansen was so proud of, it went away because these vendors said, we can't handle the deductions anymore. It's not working. We have to put you on cash in advance. And that's a death knell for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me when I was running those 17 stores at Yes Less, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea, couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record, okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, a $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed them in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with David's, quite frankly. I mean, they had to make money for a few years, but when Hansen was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just was kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies, and as we looked at his history, he kind of did this at those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me, another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too. And I was astonished one day when I came in and he was in the office next to me. I'm like, oh, why are you here? And Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in a position where I have to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them for sure. We're destroying those relationships, and it's not right. I can give you one specific example. It's one of the companies that got fined. There's Kim's Marigold, a dairy. They got fined. The CEO got fined. Their chief financial officer got fined. Personally, they got fined, as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw at Flynn, was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other and see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street, that we're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. Another startup opportunity in New York became available. Once again, we could set our corporate buying office here in Chicago. So we got the team that put the Yes-List stores, several of us back together to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, it was a private company. It's one guy. The document that none of you ever want to see again and ever want to see your name on is this. It's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to huge fines for the guy that worked right next door to me. His name's Al Abood. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Al Abood was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you would never know. You can read about it, but it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I said, at the end, it can make you stronger. I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hansen, the CEO, he hasn't been charged with anything. But it's very difficult, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom. It's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings and it's all verbal. It's never taped, but the direction is completely clear. They walk into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so they can hit the earnings that he's talking to Wall Street about. None of that is in writing, other than the notes the guys take who were in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hansen, this is what he came back to us with, that we need to, make $30 million here to hit the number. What you really judge on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he gonna sign it? Is he gonna sign it and say, yes, I believe all this information is 100% accurate? He did sign it. And I always thought that that would come back to haunt him, to say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway, that it wasn't accurate, most of it was manufactured. It's so interesting when I used to hear Ken Lay, who would just insist on his innocence, and just think, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that this is just the way of doing business. There's just some sort of a mental illness almost when it comes to that. The CEOs get it sometimes. It was frightening to watch. I walked away from big bonuses just doing what I did. The other guys that stayed, even a few months after I was there, I was 2 months away, I think, from a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. Who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality products at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands of it and said, take it from there and go. That's kind of the mode I was in right at the time I left, and I would have found something else at some point. That was not sustainable. The guy that had worked for Fleming for probably 27 years and was a merchandise manager there, and he stayed right till the end. And it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement account with the company, was all in jeopardy at that point. His wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. There are personal tragedies involved when things like this go on. It might have worked. If Fleming had ever purchased Kmart the way Sears just did, maybe their stock would be $100 like Kmart's and Sears is right now. But that didn't happen.
Stop. Okay. Okay. Yeah, so that was my brother-in-law, and he's doing very well. He's done a number of stuff at other stores in that sense, but yeah, so you wonder why that how that stuff can happen, and it kind of explains it a little bit, and the why, and one of the things that he wanted is that, look, you got to tell people that you got to realize when you're in a situation like that what's really happening, and and it's kind of hard because everyone around you, in his case anyways, everyone around was basically in on it and trying to to further this, you know, this vision or whatever. Any questions on any of it? I mean, another thing is there's a couple of a couple of the key points in there. Well, first of all, it was absolutely a company that didn't need to go bankrupt. They'd actually earned it was a profitable company. But you know, when you start increasing the profits to, you know, then you have to cover the whatever you increase the profits were for 1 year, then the next year you got to go above that. And it was amazing. The amazing thing about this company is that this didn't happen over 5 years. This happened in months, and literally within when the vendor started rebelling, within two months or so, they're bankrupt. They were bankrupt. They ran out of cash. They couldn't pay their employees. They couldn't pay vendors. They couldn't do anything. They literally run out of cash, and literally within a couple months. You know, they didn't even last a year out from the, you know, the Wall Street projection. One of the things that I think you'd always want to argue, and that is to not give Wall Street. They like projections. They say, okay, so we have to plan for whatever. I think those should be legal. You know, projections and the forecast financial statements and all that they give out. There's no reason for them. You know, what's the income going to be next year? We'll wait to the end of next year. We'll tell you. You know that. One of the things is that it's a sort of unusual. I remember hearing about the financial forecasts and stuff that are given, and thinking, well, this can't be right, because they actually have audits of forecasts, which on the surface just sounds hilarious. To audit something that hasn't happened, you know, it's kind of crazy, but there actually are audits of forecasting. When you take the CPA exam, you'll see those. I left the last part in about the Sears and Walmart. Every year I'm tempted to take that out about how he says, you know, because at that time Sears and Walmart had combined, and it was big news. And at first that people thought that was going to be a really great combination. And the historical context of that is that in the 70s and 80s, Sears was the biggest retailer, I think, in the world. And Kmart was sort of like the discount. It's sort of like Target would be sort of like the Sears, but huge. And then the discount was, the discount stores were Kmart. And Walmart was this weird store that people down south talked about sometimes. You know, but those are the two biggest stores in the world. And Sears made the Discover card, the Discover credit card, that came from Sears. And it came from Sears because they decided that they were so profitable in retail sales and stuff that they couldn't make any more money in retail. So they're looking at something else to do, because, you know, they had saturated the market basically in retail. And that's probably going to be the only thing that exists from the company. It's going to be that Discover card. The Discover card was made by Sears. And by the way, the market was owned by Visa and MasterCard. Sears was big enough and strong enough that they could make a credit card that everybody used. So anyway, any questions on any of that? But yeah, it's very, very unusual that, you know, a company literally went bankrupt. A profitable company went bankrupt within months, basically based on one person's estimate that they gave, and the consequences of that. Okay. Well, next let's see. Oh, a couple of things though. Here's a couple odd things that happened. A couple of things. First of all, is that Anthony, he mentioned in there that he was an English major. He didn't know anything about accounting. You know, never did. So that was kind of unusual in that, that here's this guy in business that's moved up, yet he doesn't, I don't know, he even had any business classes. So he really didn't understand what the accounting things were. But anyway, he dodged a bullet because he couldn't get them to sign that agreement saying that it was a rebate. And the SEC, he told the SEC, look, I tried to get them to do it, but they wouldn't do it, and I was told to do it, and I did. I tried, and they, and they said, oh yeah, we got that. And they searched all these emails, and sure enough, it had in the email that look, I can't get them to, they're not going to call this a rebate. And that if they had, he probably would have been charged. So if he had got them to sign that that agreement as a rebate, he could have been charged with it. So anyway, and a lot of the people were, and the SEC doesn't just find companies; they find people individually. So when they start talking about the people got individually fined, individuals will be fined. They can go to jail too, obviously, but you can be fined individually, not just the corporation, but the employees individually can be fined from them. So anyway, it kind of shows a little bit about how that kind of that kind of pressure works out, and again, how do you get dozens of people in on something like this, and kind of explains it a little bit, and it's a culture. And if everyone around, it's sort of like being in high school. When you're in high school, everything in the world is in that high school. All your friends are in high school. What you do socially is in that high school. What you do for work is in that high school, and all that. That's your entire world. So things that you normally wouldn't be important probably become important. Homecoming's important. Well, I don't know. If you look at it from outside, it probably wouldn't be that big a deal, but inside the high school it probably is. So you have that kind of a strange thing. The environment of the place can actually really feed it. Feed that kind of a fraud mentality. Any question on that thing? Okay, well, I tell you what, let's do this. Since we're on kind of a fraud thing, I'm gonna. I think we'll go ahead and take a break now, but I want to give you guys the. So next thing we're going to talk about is the Medtrans case. So, let's say we'll come back at what time is it? 6:51. Let's say it's 7. I'll be back at 7. And we'll go through this case. You can read through it. It's actually a very famous case, and we'll talk about kind of the implications of it. But this is a case that gets cited very often. So let's go ahead and take a break. When we come back, if you want to read through it, and then we'll talk a little bit about it. muted. Hello. So the next thing we're going to do is just talk about this Medtrans case, and this is a very famous case. It's a case that is often cited in whenever there's problems with the CPA, with doing an audit or, for instance, being sued after an audit. And it has to do with professional standards. And I don't mean the one specific to from the AICPA. There's a whole law, a group of section of law dedicated to professionals. Professionals are generally licensed by the state. Things like doctors, lawyers. My wife's a therapist; she's licensed. CPAs. These are what they call a professional class. It's a professional class of people, and they're given monopoly rights. Right. If you're a licensed physician, you're the only one that can practice medicine. I think there's nurses and that can too, but for the most part, they give you a monopoly. Who can practice law? Lawyers. They have to be licensed by the state to practice law. So, CPAs is for doing audits. So these are licenses, and the licenses are for basically monopoly for that group to perform certain services. They're usually very technical services, things that the average person can't do, not all the time, but usually. So there's this licensing thing, and those are a group of professionals. Now, there's a whole group of laws that relate to professionals. So, one of the first things is, as a professional, you cannot hide behind a corporation. So you can't incorporate your practice, for instance, and then say, oh, if something goes wrong, I'll just declare bankruptcy. Now it's, I'll say, no, that's a corporation. I just lose my corporation. And you have unlimited liability as a professional. That's why doctors, lawyers, CPAs, they get malpractice insurance. If you're an accountant working for a company, you don't need malpractice insurance. If the corporation gets sued or whatever, that's the corporation's problem. But anyway, if you are one of those professional groups, that you have unlimited liability, so you can't simply declare bankruptcy and be clear of those things, any lawsuits and that sort of thing. So that's why they have malpractice insurance. Doctors carry it. My wife's a therapist; she carries it. It's a professional class of rules, and they used to have tons of rules. In the past, they used to have rules that you couldn't advertise if you were in the professional class. You could actually lose your license if you asked somebody to do their audit. They had to ask you. So there's and they also had rules on advertising, so that if you had, on your door, your lettering on your door could be 2 inches. If it was more than 2 inches, then it was considered advertising, and they give you lose your license theoretically, or be fined or whatever. You couldn't advertise. I know it sounds hilarious now because on TV you'll see lawyers come on all the time. Hey, have you been injured? But back in the day, that was a no-no. You couldn't advertise. So anyway, they had all these rules that have built up around it. And one of the rules is that you cannot leave a client in a worse position than when you found them. That, in other words, that the client's interests take precedent over your interest. And that's kind of what this Medtrans case is about. The rules that basically you have a duty to a client that is more than, say, the general public. General public, you run into somebody who's a bad apple, you just get away from them, that's fine. It's much more difficult to do that if you are one of those protected classes. And you'll see that with lawyers too. When the lawyers want to get off of a case, or the client even wants to fire their lawyer, they usually have to go to the judge, and the judge will have to allow it if they do. They you can't just walk away from a client. Oh man, this client's bad news, I'm gonna walk away. Can't do it. And that's one of the kind of differences between, say, the CPA exam and reality, is that these rules in general, those are actually, they're laws for professionals. And the problem that people always had in the past is they say, oh, the AICPA says, oh, who's the AICPA? Well, it's this club I belong to. You're saying your club says do this does not trump the, does not supersede the rules regarding professionals. So that's kind of what this case is about. But in this case was the first one that really kind of broke down that rule, those rules that say that you can't look at professional standards, that the laws governing professionals are the ones that are most important. So let's take a look-see here. All right, so you guys have probably already read this, I assume. So the keynotes is Medtrans gave investors gave the investor unaudited financial statement showing profits of 1.9 million, and they are trying to get $10 million in financing. All right, so the CPA firm proposed adjustments that would actually show a loss. So CPA firm comes in, takes a look at the financial statements, says, look, you guys didn't make 1.9 million, you lost $500,000. Even before the firm suggested these adjustments, Medtrans CFO had resigned, indicating he could not sign the management letter. That's a bad sign. So the CFO resigns. I can't sign this, I'm leaving. All right, firm discussed the options, and the CEO the CEO threatened them. We're not proposing the adjustments that will queer the deal, or you'll be sorry. Firm withdrew from the engagement. Okay, and this is exactly what the AICPA would tell you to do. They say, look, this is someone who lacks integrity, so get away from them. So they withdraw. Oops, I don't want to do that. Isn't it fun watching me learn how to use a computer? All right, so they withdraw from the engagement, which is exactly what the AICPA would tell them to do. The AICPA's view is, look, this is someone who lacks integrity. You should get away from them because this is going to taint not only this one client, but it's all your other clients are going to be guilt by association, and you shouldn't be involved with people like this. So withdraw from the engagement. So ultimately, the third successor auditor issued an unqualified report which contained the adjustment Deloitte & Touche had proposed. All right, so this is their fourth auditor. This is the third successor auditor. So the fourth auditor issues a report, but only after they make the adjustment. And at court, they go and they say they had good cause. However, said that a CPA could not, under any circumstance, withdraw from an engagement that is unduly jeopardize the interests of the client. So at least initially, ooh, that's a little too, they lost. And Medtrans was awarded $10 million. So they were held to that, the CPA could not under any circumstance withdraw from engagement if it unduly jeopardized the interest of the client. And this is a very important one. And it might seem, you might seem a little bit odd. You say, well, why is that the rule? And if you shift to a different profession, let's shift to the medical profession, another professional group. Let's say a doctor goes in, they assume it's going to be a routine operation, and they open the person up, and it's all, it's way more complex than they thought it was going to be. That this is, much worse than the doctor says, "Oh my gosh, this is horrible," and runs out of the room. That you'd say, well, obviously that's not the right thing. Well, that is kind of the same thing as what we're just talking about right here, and that you cannot jeopardize, you can't leave them in a worse position than they were before. So anyway, the idea that you have a duty to that client, even if the client is a bad one, that you have a duty to a client, and specifically not to leave them in any worse position than they were before. And here's the thing about withdrawing from an audit that is different than even, say, the medical profession or the legal profession. A lot of times the audit is dependent on things that happen at certain times. For example, taking inventory, performing cutoffs, of purchases and sales and all that kind of stuff. So when you withdraw from an audit, it may very well be past, you withdraw from an audit in January and they took an inventory on December 31st. The new auditors can't jump in the time machine and go back and do that inventory. Now you can work with them and give them the information you have, but the point being is that it's time. An audit is time sensitive. That things have to occur at a certain time. So to be on site for cutoffs and things like that is a very important thing. And when you withdraw from an audit, especially if you withdraw from the audit past the year-end date, it really runs into problems. The AICPA will tell you to, withdraw from the audit, but the reality is that is a much more complex thing. You definitely want to talk to legal people before you do that. Okay. However, and this is the strange thing, this is the first occurrence of it. Let's make it in, I don't know. We'll make it in green. How about that? Later, the Court of Appeals reversed the decision, holding that judges should instruct juries about AICPA standards in which authorize withdrawal from an audit engagement based on good cause. Now, my guess is that this was really viewed by the court as a terrible miscarriage of justice. Saying, look, even though they have these standards, that's really not what was going on here. They have these standards, however, for professionals, however, that they can look to their professional standards specific to their group, for instance, the AICPA standards, for guidance in this. So this is one of those cases where the law really changed, and probably changed for the better. And that, the idea was that if this is allowed to stand, this is a, first of all, it would encourage this behavior, and second of all, that it really would be a miscarriage of justice. And so this is a case that has stood up for years, and it has been cited many times in situations like this. The point being, though, well, a couple points, and that is that while this case highlights, you don't want to withdraw from something. You don't just leave a client when they're no good. There also is that idea, though, that there are times when you can, and if you have a client that is particularly, in this case, you can certainly be argued that their actions caused it. That there is a little bit of leeway, but it would still be a fairly serious thing to withdraw from the audit. Okay, now let's play. What should have Deloitte and Touche done? Now they went to court here. I don't know how much they spent on the court case, but whenever you run into a court case, a lot of times it's a losing proposition. So, what should have Deloitte and Touche done differently to avoid this? There's actually a very easy solution to this. Anyone? Is it because my door's open here? I noticed it because it's colder on that end of my basement than it is on the other end. So I noticed that door's open when I start feeling cold air. Anyone? No one? What could Deloitte have done? What should have they done? It goes right back to what the first thing we did the first day, talking about what are the auditor's responsibility. The auditor's responsibility is not for the financial statements, it's for offering an opinion. So what should have Deloitte and Touche done on this audit? And if you're ever in the situation, what should you do on an audit like this? You run into a client that's like this. Anyone? Are you guys sleeping? You guys are probably sleeping, aren't you?
We're here.
No.
I mean, they could have offered a qualified opinion and just come out with, if management's not willing to go along with making the changes, and they just come out with their report of what they saw, which is that it's a loss, and and maybe there's some uncertainty even to what they're saying because they don't have good information.
Yeah, absolutely. Either an adverse opinion or, like you said, a qualified opinion, some kind of a modified opinion. Exactly. That's why those modified opinions are there. And hopefully you tell them you're going to issue this modified opinion. I mean, part of that is that you can give that, but you're also kind of hoping that wakes them up and makes them, change whatever it is. But they could have definitely issued a modified opinion, like you said, a qualified opinion or an adverse opinion, either one of those. And that is kind of the remedy that we have, is that we can offer those. And at that point, you have fulfilled your duty to that client. You have a duty to give them an opinion. You gave them an opinion, and that's it. So withdrawing is one of those things that, you have to really take it seriously. If it's early enough in the audit, you might be able to get away with it, but certainly after, say, year end, it becomes more difficult. So, another lesson to learn from this, if you get pulled into court, basically at that point in time, you're probably losing money on the audit. I mean, usually a court case is going to cost you considerably, and just to avoid that, your best bet would be not to withdraw, but to give them a qualified or adverse opinion, and then you can leave them as a client, because then they have a year where to find somebody else to get in there. The next auditors that come in would have the their year end. They could do the inventory and all that kind of stuff. So anyway, that was kind of it's a very famous case, and it's been cited many times. So it isn't that it isn't a one-off strange case. It actually has been used in other cases too. Is something that is kind of broke a little bit that ironclad professional standards thing. Okay, what time is it? Oh, all right. Let's go to. I think we'll continue on with the chapter 6 and 7 handout. This is the same one we had last week. Kind of. It's kind of a long one. So, this is from last week. Is there one that does not have this? The chapter 6 and 7 handout? Okay, so it looks like we got to page 4. And I am going to look at something really quickly and see if. Okay. So I think we're starting on page 5. My guess is we are not going to finish this week. Okay, so I think what I told you guys last class, at least I should have, is that so next week is week 12. Week 13, we're off for spring break. So I think I'm going to do the, so next week I'll do the, we'll do the review of the sampling. And then I'll give you guys a sampling exam. And that way you get a good couple weeks for you to work on it, to turn that in. So the sampling exam will be, I will do a practice exam, kind of bringing them all back together and refreshing our memories next class. And then I'll send out the actual sampling exam. That again, it gives like an extra week in there. Okay. So testing of controls relating to relevant assertions. This is similar to what we do for testing for account balances. Generally speaking, the internal controls are there for the same reasons as they would be for the substantive testing. And similar to the other kind of testing of the relevant assertions, maybe next time I'll send out a thing on relevant assertions. You say, okay, well, memorizing all the stuff that goes into, say, occurrence, completeness, and all this stuff. You come across something in these different groups that a lot of times they're exactly the same thing. For instance, I'll talk about this in a second. Segregation of duties, completeness, segregation of duties, and so on. So there's a lot of times you'll find things that are, repeat for the different groups. So the point being is you don't necessarily have to memorize all the things for each one of those, because oftentimes they are the same as other ones. So there really isn't as many different variations as you would think in those. Okay, what I want to talk to now, I don't think, did we go over segregation of duties before? I don't think we did. I'll start and then someone yell if you remember us doing this. You remember the segregation of duties by car? And the C being custody of assets. Let me do something different. Oh, where'd it go? Here we go. Authorizations. And record keeping. And there's a fourth one that is less well known, and it's usually known for governmental accounting, and that is reviews. And I don't mean the audit report or the a review report. What I mean is things like reconciliations. Bank reconciliations, reconciliation of customer accounts and that sort of thing. So sometimes this is a sometimes you'll see this as a car, and hopefully when they show it to you that they spell reconciliations correctly. And so this one is really not a is oftentimes not really shown as the major one. So this will be, these are the duties that have to be segregated. Sometimes this is called incompatible duties. Okay, so here we go. I'm sorry. My spelling is never good. So segregation of duties, sometimes called the incompatible duties. In other words, two people should not have these two, should not have those same duties. Okay. So custody of assets. And let me give you an example. Let's take cash. So cash would be the Treasury Department. So they would have custody of the assets. One of the authorizations would certainly be the accounts payable people. So accounts payable will match up the invoices and the purchase orders and the receiving reports and authorize the payment. So the Treasury Department has the custody of the cash. The accounts payable people will authorize it, and the record keeping is done by the accounting people. And by the way, the accounting, this is usually where this is where usually the bank reconciliations are done. So my point being is this one down here, it isn't that we ignore that, it's that those are usually thought to be done in the accounting department. So the accounting department will do it, and they'll do usually bank reconciliations would be their way of checking on the cash. Like I say, this. I should maybe even make this less of a thing. This is only for the specialized for the governmental audits. Okay, so the accounting department will do, say, bank reconciliations. And all of these are segregated. Now, you might say, okay, well, if the Treasury Department, if the Treasury is, they're handling the cash, why don't they just do the bank reconciliation? They know more about the cash account than accounting does. So why don't you have them do the bank reconciliation? What could happen? So the Treasury Department, they have the cash. They set up the bank accounts. They will set up all the bank accounts that will fund the say payroll and things like that. So why don't we just have them do the bank reconciliations? What would be the problem of it? And I will tell you too that the problem is serious enough that when I worked at US Steel, they kept the accounting people and the Treasury Department were in two completely separate buildings, like 10 miles apart. They really segregated the duties, 10 miles between them. Why? Why not just have the Treasury Department do the reconciliations? They can take the checks that cleared and all that kind of stuff. Why don't you have them do it?
That's open to fraud. They can manipulate the numbers.
Yeah, exactly. They could do something bad with the cash. They could transfer to their own accounts or whatever like that. However, the accounting department will catch it. If they were also doing the record keeping, they could make the cash disappear, and they can make it disappear through the bank reconciliation or just in the accounting of it. So they could cut it, and if that happens, it's very hard to find. So that's one of the, part of the thing is this is sort of like a more layman term would be checks and balances, is that they can take the cash. There's probably ways that they can do it and hide it for a certain period of time, but it's going to get caught. And it's going to get caught by the accounting department. So in any one of these, whenever you come across something there's a problem, it usually has to do with somehow these got combined. You combined the custody of assets or the authorization of the record keeping, whatever it is, that those were combined. Okay. Yeah.
Sorry, I was saying that's just like the controller that was in Dixon because she did all the duties.
What happened?
That was like the controller in Dixon. I forgot her name, Rita Crutwell, something like that.
Yeah.
She did everything.
Yeah. Well, we had a kind of the opposite thing. Well, it actually similar thing happened. When I had in Brookfield. I'm from Brookfield. And about 10 years ago, they had a finance person who, I don't know if they quit or they're fired or whatever happened, they left. And they never replaced them. They had all kinds of problems because there's no longer a finance person there that says, wait a minute, where's this going? Where's this going on? And so we thought that we had something like $8 million in fund balance, carrying forward, that, okay, that's a good balance for the town to take care of. When we actually had something like 400,000, which was terribly low. And it was because it's basically taken out the record keeping. And not only that, they didn't have a finance person that really even knew what the rules were. I mean, it was even kind of worse than just a segregation of duty problem because they didn't know how to make the financial statements. So anyway, yeah, you can run into these. And by the way, another thing that to know about this, generally speaking, smaller towns, businesses, whatever, a lot of times are much more susceptible to this because they don't have that many people. For example, if you're in an office and there's 2 people in the office, you can't segregate the duties. So it's not uncommon for someone coming from smaller, for instance, towns or companies or whatever, to have those kinds of problems. And one of the things that I think people are always surprised about is that, a lot of times these frauds happen, they do happen in smaller towns in ways that you wouldn't have happened in larger. People tend to think like, oh, they're, city of Chicago, there'd be, probably terrible corruption and all this kind of stuff. Not usually, because they have enough people to segregate all the duties out. It's usually you have much better controls over a large city than the small ones. The numbers are smaller, the dollars, however, the opportunities are usually much better for the thing to happen in smaller towns and in smaller companies too, than large ones. So there is this kind of thing that I think the people tend to focus on large cities being more, being more corruption, but as a matter of fact, you can probably get away with it much easier in smaller ones. Yeah, there was a movie, something called I don't know if it was about her, the horsewoman or something like that. There's this woman who was the finance person for some small town that literally had some like $27 million show horses or something, making $60,000 a year. So
Her auditors ended up getting sued and lost a lot of money for that town because they were also her personal accountants. And they were on her $45,000 a year salary. She had this multi-million-dollar racehorse empire, and they were doing all her taxes, and the inflows of her earnings would have been like very obvious, like that she couldn't have sold all these assets and bought millions of dollars. Where did the original money come from? And her basically annual, they were doing her taxes as a favor for her, but it ended up sort of biting them in the end.
Well, and if she's making 45,000, that probably wouldn't take the for the upkeep of one of those horses. This like crazy amount of And by the way, one of the things about CPAs is that we are under also part of the professional standards is that you also have a fiduciary duty to the public, so that if someone is cheating on their taxes, you have a fiduciary duty to the public to either withdraw from that or to not allow for those things to happen. So it's another duty on the CPAs that is beyond what the normal tax preparer has to do. So yeah, and some of the stuff, it's hard to believe that in like the length of time and all that kind of stuff. So, yeah. Okay, one of the things that I always find hilarious, they talk about pre-numbered documents, and then they'll talk about them serially numbered, like you just number them randomly. But anyway, serially numbered documents, and that is that every document that is made, whether it be purchase order, receiving report, anything like that, that they're serially recorded, and so that you can actually go through and find any missing ones. So you'll make sure, if they had 200 of these, they'll be serially numbered, and if there's anyone missing, that could be a problem. So it'll be a receiving report or whatever, that these documents are serially numbered and that they are accounted for, that someone actually goes through and counts and says, okay, what happened to purchase order number 78321 or whatever it was. But it also cracks me up, like they also emphasize that they're serially numbered, randomly numbered. Daily or monthly reconciliations, and this is one of those things that is generally done here. The reviews and the reconciliations are usually done in the accounting area, but invent review. And so one of the things we also talk about the bank reconciliation, but there's also reconciliation of, say, customer accounts, payments from customers into their accounts, and that you reconcile those. It could be for vendors' accounts also, same thing. Completeness, same thing, segregation of duties and all that. Authorizations, and this is actually can be kind of a big one. Those that are people who are authorized to make transactions, and this is and the authorizations are one of those things that can be problematic in these up here. And one of the odd ones that I ever had of it being a problem is I was at when I worked for Navistar, I was at a place in Chatham, Canada, which is about a couple hours from Detroit. You go across the river into Canada, across the, whatever the bridge is there, I don't know what it's called, but anyway, you go across the bridge and you're in Canada. And a small place, but anyway, they, in the accounting department, they would have the people they had one finance person basically who would come in and write the checks, and the check machine was in the accounting area, and it broke. And it broke when they were supposed to be printing the checks to pay the people. I think it was for the next day. So they call somebody in at the end of the evening, they come in. Now, notice what this is. This is the accounting department. Right? They do the record keeping. And they authorize the payment. So you actually had to, now nothing bad happened with it. And the only reason why I came across it is that anything with the accounting department, the authorization had to be done by it literally said anyone outside of accounting could do the authorization for the things purchased in the accounting department, any manager, and it didn't happen. You say, well, how did it happen? Well, it didn't happen because the person writing the checks just ran an extra check and gave it to the people who were who fixed the machine. So they gave a bill of, I think, like $400 or something. Ran through the checks. Oh, what do we owe you? $410, whatever it was. They ran the check through, gave them the check. It was never approved. It was never authorized. And so it was a very weird situation, and it came out because it was for the accounting department. So the authorization, was the problem itself. Was that the accounting department called out the people to come in and fix the machine, what they needed to do. However, that caused the problem, and it literally was never authorized, the payment, even though it was a valid payment. Very weird situation. Okay, so yeah, so these can be, authorizations can be tricky, and the standards are more concentrating on the authorizations, knowing that this can be a big part of the problem, people who can authorize things. Okay, most of the stuff, kind of obvious, accuracy, verification, reconciliations. This is for each individual account, the individual transactions, and this is for at the end of the period. This used to be in the completeness or existence, but it's got its own separate one now. Except that this is not in the PCAOB standards. There is no cutoff in the PCAOB standards. I don't think it matters too much. But anyway, okay, so let's. But so you audit, your internal control auditing is also to those assertions. Oh, you might be looking for a few different things in those, but there are the same idea, is that you're basically looking at their ability to prepare the financial statements, free material misstatement. So it isn't necessarily that you're looking for the dollar amount, you're looking for the actual controls. Oh, we just talked about this. Effective size on internal control. Generally, generally small organizations have difficulty with internal controls. They generally have fewer people. It's very common to have one or two people that handle the financial areas. It's very common to have that. And then smaller, whether it's a city or it's a company or whatever it is, it's very common to have, they just have too few people. and only though they have too few people, they really don't, a lot of times the people that are running it are not really familiar with internal controls. And I can tell you that people even in large companies a lot of times are that familiar with internal controls. I really, when I started auditing, I really realized how kind of strange our profession is, and that most people don't think the way we do when it comes to internal controls and things like that. Most people, they come into the place, someone in the company tells them how to do their job, they do their job to the best of their ability, and that's it. They don't think about why and how and all that kind of stuff that a lot of things that are involved in it. Whereas as auditors, that's a lot of what we think about. So a lot of times, yeah, that now there's many small companies have difficulty with internal controls. Large companies are usually better. Large organizations. They usually have. Now here is another situation though that a lot of times you can run into. When a small organization goes into a larger organization, it's fairly common to have a company when they start growing, they're still operating with the small organization controls, and a lot of times at some point they fail, and that things get out of control. Things that wouldn't get out of control in a small place, but as you start getting bigger and more complex, more people, more whatever, you can have a problem with it. So if you're auditing a company that is growing, and especially if they're growing fast, you certainly should be aware of that their control structure may not be what it should be, because it may be, that size when it should be, for a larger place. So anyway, that's the intro. And I've talked to people who have their own CPA firms who have done audits and stuff, and they said, I think it's funny that the CPA says get an understanding of their internal controls. So we understand it perfectly. They don't have any. There's two people in the office. They don't have any internal control. Now, what do you do if you run into a place that is small and doesn't have adequate internal control? So let's say that you have a small small business with adequate internal control usually focuses on the owners. Hopefully there's only one owner, but it could be more than one. And the idea is this: usually you can rely on that the owner is going to oversee things enough to know, if it's their money, they're going to guard it. They're going to do whatever they can, to make sure that nothing happens with it. So hopefully you have somebody that's involved in the business, the owners, and ideally it would be one owner, but it could be a couple of them. But anyway, the point being that those owners of a small business are going to focus on, for their own greedy self-interest, making sure that money gets deposited, doesn't get skimmed, and all that kind of stuff. The advantage being is that then you can focus on the owners themselves. So then you can focus on the owners and their bank accounts and so forth, to see if there's money coming from the business that they're not accounting for or whatever it is. So that that your focus then becomes not on the internal controls, which don't exist, but on the owners. And the idea that instead of looking at a number of people in the organization, you focus on those owners, and the owners are the ones that you're going to kind of base your internal control on, that hopefully they're very hands-on in the business and know what's happening. Is it possible that they don't? Yeah. One of the cases that I gave you guys in the test about the owner didn't know anything about financial statements and didn't really care. I actually worked for someone like that. It was really frustrating because oh, these tables should be, the tables are red. These tables should be blue. Change these to blue. But you can't do that. We just paid $18,000 for the tables. Well, they should be blue though. No, you don't understand. It's 18. The tables are fine. No one cares. Okay, but it was actually fairly frustrating work. Okay. Inherent limitations on internal controls. What this means is oops. I don't know if we talked about this or not. I can't remember. The best internal controls can fail. Can we talk about this? And there's basically 3 ways that this occurs. So internal controls can fail. The first one, and probably the most serious one, is management override. And this is kind of what we saw in that Fleming case. They talk about the controller. They say you can't do this, and they talk to enough people, and they would finally get them to do whatever they wanted. So management overrides when management steps in, says, okay, forget about those controls, forget about what we need you to book this amount. We need you to book $30 million of profit or whatever it is. So management override, even if you have the best designed internal controls, management override can foil them. They can fail because of management override. Another way I'm sorry, collusion. And collusion is let me look at this. 2 more employees working together to foil segregation of duties. And I'll tell you my boring old story about that in a minute. And third one being I'm actually going to put 4 in here. I'll say operational error. And they also, let me change this a little bit. I think they say operational, these are mistakes. C and D used to be together. And IT errors in programming. Mistakes used to have both of these in there. These are the same mistakes. But now I see that a lot of times they'll have these broken out between people who don't know how the controls are supposed to operate and people who do the programming that they have errors in the programming. To be honest with you, I think that is not necessarily a limitation of internal control, but you'll see that in there. Anyway, so conclusions when two or more people, employees work together to foil the segregation of duties. So you have people who have the authorization along with people who have the custody of the asset. They say, hey, let's get together and I'll authorize it and you give us the goods and we split it or whatever it is. So conclusion is, yeah, it usually has something to do with the segregation of duties that they're trying to overcome. Operational mistakes. Employees do not know how the controls work. And you cause them to make a mistake. In IT programming, just kind of, well, I'm going to explain that one. You guys probably can figure that one out. When they do the coding or whatever, that the programming is either as a mistake, either in the coding itself or in the design of it. We talked about the bank. Was it JP Morgan that paid out the billions of dollars or whatever it was? Yeah, the design, either in the design or in the coding of the internal controls that, and more controls are computerized. And I think I mentioned this before, maybe I didn't, but usually computerized controls are usually better than non-computerized controls, pencil and paper controls. Why? Because the system will not let you do things, whereas in a manual system, a lot of times people might be able to override something or do something, whereas in the IT system, it doesn't allow for it. You can't do it. So sometimes they're better. The problem is that if there is a problem with the IT system, a lot of times the problems are more pervasive. They're more throughout the company. That I don't know. I think for you guys. So for instance, if I have this calculator that's I'm going to sell this calculator for $4, and instead of selling it for $4, I'm in a store and I actually mark it that it's 40 cents. Okay, so I sell this calculator. I should be selling for $4. I sell for 40 cents. Okay, that's one calculator. So 40 cents, not that big a deal. Online, if you have this $4 calculator, you're selling it for 40 cents. You might sell 10,000 of them before you know there's even a problem. And all of a sudden you get 10,000 orders for 40-cent calculators. So a lot of times the IT stuff will, while it usually is a better control, when they do go bad, they go bad a lot of times in very big ways that you don't have with a manual system. Okay, operational mistakes. I'll tell you about this one. I may have already told you about this one. Did I tell you guys about me working in a bicycle shop? No, all right.
Yeah, I think you did.
Yeah, what I didn't, we didn't know that the cash registers actually recorded, stuff. The collusion one. Did I tell you about the collusion one? The tractors? Can't remember.
Not that I remember.
No. Okay, I work for Navistar, and Navistar used to be International Harvester, and they made tractors. They made a bunch of stuff. One of the things they made was tractors before. They actually sold the tractor business, but they sold tractors. And so now tractors are very specialized. They're tractors for, you know, all different, you know, whether corn or wheat or where they're at, location, and they're very matched up to the environment. That, you know, you don't just put a big engine. It's not like a car where you just put a big engine in it and sell a thing. But tractors, if fuel efficiency is huge, you know, you don't want to have a tractor that puts out, say, 300 horsepower when you only need 120 horsepower. You know, you can do it with a much lower, or, you know, so they're very, usually very specific. The wheels and everything about them are very specific to whatever job they're doing. All right, so, and because of that, they're usually ordered very specifically. That if you had someone in whatever, Iowa, you know, they're going to have tractors that are for harvesting corn, and the dealerships there are going to order tractors that are configured for harvesting corn. And if you go to Idaho, it'll be for potatoes, or whatever it is. The point being is they're very different, and they're virtually always special ordered. Many of them are, anyways. And they don't build them until there is an order in for it. So, you know, that's one thing about tractors. They're very much unique to wherever you're selling them at. So when I was at Navistar, and, you know, when I was at Navistar, it actually was a couple of the employees involved in this thing were trying to get their jobs back because of it. But anyway, they got a note from an employee that said that they know that there's a tractor being stolen every month out of this tractor plant. There's a tractor plant in Minnesota. And every month they're stealing a tractor, which is hilarious because, you know, people, they're all special orders. So someone would say, "Where's my tractor?" You know, if they were stealing one. So they don't know what to make out of this. And finally they said, okay, well, and this person wanted $2,500 ahead of time, and then $2,500 after they showed them, you know, how they're doing it. And so, you know, finally they talked to some people and they agreed to do this thing. And the guy met this person in an airport up in you know, Minnesota, some little airport, and the guy was wearing a red carnation. It was like from a bad movie. But they had the local police there, and the guy told me, you know, wait in this field across from the assembly plant, and you'll see. So they were all waiting in this field. Auditors were there. The guy was there. The informant was there, and they had police officers there. And the night shift, 1 in the morning, everyone comes out for their night shift, and all of a sudden the tractor pulls out of the place, goes onto a truck, and the truck takes off. And the police go after the truck and catch them. So they, you know, the guy was right. They were stealing tractor, and what they were doing is, and they ended up having 27 people. And this is one of those things that, again, that I'm, you know, that is always amazing, is how many people, how do you get all these people to, you know, to do this thing? But anyway, they had 27 people that were involved in this. That, and then one of the people was an accountant. There was an accountant that worked there at night. And what they would do is they would scrap an entire tractor every month, part by part. So they'd say, okay, these wheels came in, they were bent, we scrapped them. The wheels were fine, they just went and tucked them in the corner. This engine came in, we dropped it off the forklift, the engine's no good, we scrapped it. Engine's fine, they go put it in the corner. And then they would build the tractor on the assembly line. And people could actually order this stolen tractor however they want it configured. If they wanted a certain engine, okay, bring in, oh, we dropped that engine, and okay, we'll go put it in the corner. So it was this operation, and there was literally 27 people that were arrested anyway, in this thing. And it was, you know, supervisors, employees, they had an accountant was in there, security guards were in there. There were all, you know, the 27 people that were arrested. And by the way, when I was there, the only reason why it came to light for me was that two of these people were trying to get their jobs back, who were involved in this thing. But anyway, the point being, if you have 27 people colluding, getting together to do something, it's really hard to find. And the former director was Navistar, something, and he said it seemed completely outrageous and ridiculous that it was happening, but it actually was. And so they found this out. They paid the guy, and by the way, and here's kind of another one of the funny parts of the story. Why do you think the guy became an informant? So the guy knew about it. He knew everything about it. Why do you think he became an informant? I'll give you a hint. It wasn't his conscience that got to him. There was some other reason why he became an informant. Anyone? This was done in the night shift, and he was the most senior employee. There was an opening on the day shift, and that goes to the most senior employee, and he was given that day shift job, and they cut him out. He was one of them until he got promoted to the day shift, and then they refused to give him his cut, and so he turned them all in. But honor among thieves, I guess, kind of broke down at that point. But anyway, that was the reason why this came to light. Again, it's a very strange collusion case, and that to have that many people involved in it, and you can imagine that for the most part, it probably became more of a culture thing than anything else, and that it becomes normal. And I'll give you one more boring story, and then we'll call it a night. I think I told you in laser cutting for steel, they use platinum. And the supervisor over this job, there's 6 employees on it that would do this laser cutting. And the idea is if you make steel's hardly worth anything. But if you cut the steel and sell it, so if a customer orders some steel, you'll cut it for them and then sell it to them, it's worth a lot more money. So that's what we would try to do. And we had these laser cutters that use platinum. The supervisor didn't realize that you didn't have to replace the platinum all the time. The employees convinced the supervisor that no, the platinum gets used up in the process. And so they would take the platinum and sell it and split the money up. And we're talking about people that made over $100,000 a year 20 years ago. And they would go and sell this platinum, and they'd all split up, $100 a piece or something. And it came to light because, not kidding, the vice president of operations was walking through, kind of patting people on the back. Hey, how you doing? All this kind of stuff. Talked to the new employee. The new guy didn't know that it was illegal because it was so openly done. The new guy says, well, no, I'm the new guy, so I'm the guy that has to go sell the platinum and give the money to everybody. Tells that to the vice president of operations. Vice president of operations, of course, calls the internal audit department and says, is this right? No, that's not right. And literally all 6 of those people lost their jobs. And again, this is one of those things that it doesn't make rational sense that someone would lose what basically would be in today's dollars, a couple $100,000 a year job for a couple $100, maybe a month. But that's what happened. And it was a very strange thing, though, that the environment was so entrenched and so casual with this that the new guy, no one explained to the new guy that, look, this is illegal. We can't, we're not supposed to be doing this. He told the vice president of operations about it. So anyway, all right, I think we'll stop there. Let me see where we're at. Okay. Okay, so we'll stop here. So I'll say, all right, so next week, don't know if we'll finish this next week. We might. But anyway, next week we'll do the statistics practice exam. We'll see how far we get in the internal control handout, but then I'll give you guys the exam for, I'm sorry, Julie table. I'll give you guys the exam for the statistics, and then we'll have 2 weeks basically to get that in. Any questions? Okay, guys, good night, and I will see you next year. No, next class. All right, good night, guys.
Good night.